All right, today we're diving into Sprouts Farmers Market. Their recent earnings call was a really interesting one. On the surface, the numbers looked pretty good, but the way the stock reacted, well, that told a completely different story. So let's get into it and figure out what was really going on.
So here's the puzzle right up front. Sprouts comes out, they report their earnings, and it's a beat. They made more money per share than anyone expected. Now, normally, that's a good thing, right? You'd expect the stock to pop. But nope, it went the other way. So the big question is, what did Wall Street see that the headlines completely missed?
And the answer really is simple when you think about how the market works. It doesn't really care about what just happened. It's all about what's going to happen next. And what Sprouts signaled was a major slowdown. That's what overshadowed everything else.
But before we get to the guidance that really slammed the brakes on this thing, let's at least give them credit where it's due. Let's quickly cover the good news from Q4, the numbers that the market pretty much ignored.
I mean, if you just look at the numbers, you can see why someone might have gotten excited. Earnings per share came in at 92 cents, which was a nice beat over the 88 cents everyone was expecting. Revenue was right in line, up 8% from last year. On paper, this is a very solid quarter. No two ways about it. And that positive momentum was there in their comparable store sales too. That's a super important metric for any retailer. It tells you how sales are doing at their existing stores. And they grew a healthy 1.6%. That shows the core business was actually doing pretty well at the end of the year. And then on top of all of that, they announced a massive new $1 billion share buyback program. $1 billion. Now, you're going to want to file this piece of info away because it's a huge part of the story. It acts like a financial safety net for the stock, and we'll definitely come back to why that's so important later on. Okay, so that was the view in the rearview mirror. Everything looked fine. Now let's turn to the road ahead because this is where we find the real story of this earnings call. This is the guidance that completely flipped the script. And to their credit, management was super direct about it. They flat out said 2026 will be a challenging year. Why? Because they're up against some really strong numbers from the year before. It's what analysts call a tough lap, like trying to beat your personal best record in a race. It's just hard to do. And wow, this chart really just says it all, doesn't it? It shows you that abrupt change in direction. They went from that positive 1.6% growth we just talked about to guiding for a negative 2% in the very next quarter. That's not a slowdown, that's a screeching halt. And when you zoom out to the full year, the picture doesn't get much prettier. They're guiding for comp sales to be basically flat, and earnings per share, flat too. So the big takeaway here is that the high growth story that investors have gotten used to, well, that story is over, at least for the time being. Management also explained why Q1 is going to be particularly tough on their profits. They're expecting a nearly 1% hit to their margins. It's kind of like a double whammy. First, when sales go down, but your rent and other fixed costs stay the same, your profits get squeezed. And on top of that, they're spending some money to get a new loyalty program up and running. So, a tough spot to be in. So, okay, things look challenging. What's the plan? What's the playbook to get through this? Let's break down the key things management is counting on to navigate this slowdown and get back to growth. Their whole strategy really comes down to three main pillars. First, they're going to use all the data from their new loyalty program to figure out their customers better. Second, they're taking more control of their own supply chain to manage costs. And third, they're tweaking what they sell to make sure it hits the right spot for shoppers worried about affordability. Now, this self-distribution thing is actually a pretty big deal in the grocery business. By running their own warehouses and trucks for things like fresh meat, they get way more control over freshness and, this is the key, their long-term costs. It's a really important tool for protecting their profit margins down the line. Another huge part of their strategy is their own private label, the Sprouts brand. I mean, look at this. It's a massive $2 billion business, making up over a quarter of all their sales. And this isn't just about offering cheaper stuff. It's about having unique products you can only get at Sprouts. That's a real competitive advantage. Okay, so while the actual business of selling groceries is facing some headwinds, there's a really powerful financial move happening in the background. And this is where that massive buyback program we mentioned earlier comes back into play. And here's why this is so critical. With $1 billion authorized and at least $300 million of that planned for this year, Sprouts is basically creating its own support system for its stock. By buying back shares, they reduce the total number out there, which automatically boosts the earnings per share number even if total profit doesn't grow. It's a way to put a financial floor under the stock.
Okay, so we've gone through the solid Q4, the kind of scary guidance, management's turnaround plan, and that big buyback safety net. So now let's put it all together and give you our take on what to expect from here.
So, after a call where management basically hit the reset button on everyone's expectations, the only question that matters for investors is what's the call on the stock now? Here's exactly what we'll be watching for on the next earnings call. First, did they manage to keep that sales decline in Q1 from getting any worse than they predicted? Second, are we seeing any signs that the pressure on their profits is starting to ease up? And third, we need some actual proof that this new loyalty program is working. Oh, and just a quick little side note, they have an extra week in their calendar this year, which should give their final earnings a nice little 21-cent bump. So, taking all of that into account, our rating on Sprouts Farmers Market is market perform. And here's the thinking behind that. That huge buyback program provides a really solid floor for the stock, so there's good downside protection. But on the other hand, the company's growth has basically stalled out. Until we see clear proof that the business has hit bottom and is starting to turn around, we see the stock as being stuck in a range. There's support, but there's just not a clear reason for it to go a lot higher right now. And as always, just a final reminder, this is not financial advice. This explainer is for informational purposes only.